Hello guys, welcome to my stream. Today, uh, I'm thinking that I should learn the price action trading as I'm starting from basic zero. This is my first time streaming, and I would like to learn what is trading, how the trading works. I invested a couple of bucks the recent month. I tried to make something, and it didn't work out. And uh, basically my plan is to learn trading from scratch, and I would like to build a plan while the process is going on. I still have doubts regarding which course to study. Basically, either I should go to ICT trading or SMC or price action trading. I have a lot of confusion, and the main thing I'm looking to why I'm streaming is basically I want to learn how the people think and what is the market is going to do, what stages the market contains. Sorry, I'm speaking something random because this is my first time streaming, and I'm learning. So I purchased a course from L. Brooks. He's having some good knowledge uh, on how to do the trading and everything. So this is my first time learning and trading, and hope you are having good time. Uh, I'm from Finland basically, and this is my first day of trading. Means I traded before, but I never had any experience of how the trading works. I just gambled whether it will go up or bottom, and I tried some strategies that told in online in YouTube's random stuff. Basically, I tried to do what we'll say is like a 15 minutes orb of the New York session, Asia session, London session. When the market opens, I tried over trading, did 70, 80 trades in a day, took almost every trade that I can think of, double bottom, double top, whatnot. Just did all those things, and nothing worked. So that's what I'm just looking at. Uh, the thing I'm looking is like learn trading first. So I just started. As you can see, this is my first day, so I don't know how it goes. Okay, let's start. What will happen uh, in this one? So basically, the L Brooks have some. Guys, can anyone see my screen or anything? I can check it. Mm, Just give me a second, guys. Uh, uh, So I can see I'm streaming, and I would like to start from scratch. And what is the first thing I would like to do is like I'll show you what are the contents that are available and how this works, how the L Brooks price action trading looks like, and let me. Uh, so the plan I'm going to look at is that basically I'm learning L Brooks L Brooks trading. So I'll just show you guys. Yeah, you guys can see that chart over there. Give me a second, guys. I'm still figuring out how to do this one. Mm. Yeah, it was quite awkward. How can I do it? What is the things I'm looking at? I purchased from some. Oh, okay. So basically, what we'll say is like basically we'll start with having. I'll just write it, note it down. Numbered list. Yeah. Okay. So first we'll start with what is price action? What is price action? What is price action? Then what is market cycle? Basically in this market cycle, what we'll have is like uh, channel trend, what trending range and everything. The next thing is that what is institutions uh, institutions doing. Spelling is wrong, sorry. Institution is doing into the market, how they are playing in the market and everything. Then what is the setups that are looking, what is the setups that are available, that from the scores uh, available, and bar count, signal bar counting, signal bar countings, uh, signal bar countings, then pullbacks. Uh, then next one is pullbacks and counting. Pullback once by using Fibonacci rule and other status bar counting, like ABC correction, something like that. The next thing we'll look is like what are the trend types that are available. Trend types that are available that are available. Oh fuck, man. Available. Then channels and micro channels. When there is a spike, then there will be correction, then trending, then the trending range, then some reversals, like wedges, tops and double top and bottoms, double top and bottoms. Then head and shoulders, then scalping, a little bit of scalping we'll learn. Then trading MTR tops, trading MTR tops, MTR tops, trading MTR bottoms. We'll start understanding what is MTR in the next sessions as we learn together. Hmm. Then trading in strong bear channel, trading in strong bear bull, trading in strong bear bull and weak bull and weak bear and bull channels. Then trading in channel reversals, trading in channel channel uh, uh, reversals. So these are then we'll build the final one is build a strategy, build a strategy of what we are going to do, what we are going to do, and some everyday live trades, everyday live trades. So this is my next week plan. This is what I'm going to do. So basically, as you can see, man. So this is what the things I'm planning to do for the next week. I'll try to create a Excel sheet and where we can fill all the things that are okay, that are necessary, and everything. Then I'll just okay. This is what the next plan is, and the next thing I would like to do is let me set up a channel this stream first, and it doesn't have majority of the man. Mhm, mm, mm, mm. Hi guys. Hmm. Okay, so I just added some things in the stream. So first we'll learn what is price action. Okay, let me start the price action. Hmm. So basically, I'm from Finland. I will do regular streams from now on. I'm starting out, but I will show how consistent I am. And okay, let's start with what is price
This
action.
is Al Brooks, and this is my price action trading course. This module is entitled, What is Price Action? Price action is any representation of price movement, and it's on any financial instrument, stocks, futures, bonds, it does not matter, and on any type of chart, a bar chart, a point and figure chart, a volume chart, a range chart, a raincoat chart, a candle chart, and it can also be on any time frame. So for example, on a candle chart, a 1 minute chart, a 5 minute chart, a daily chart, a monthly chart, any movement on any of those charts is an example of price action. And price changes with every tick, and each change becomes an example of price action. When you're looking at charts, some things look very minor at first when you're watching them, but you should not dismiss anything. Uh, Everything that happens is happening because a group of institutions are making it happen. And our job is to follow what the institutions are doing. And if they're able to move the market, then you have to assume that something is significant happening with every tick up or down. So sometimes things look very unimportant, but they can lead to great trades. I believe that price action is genetically based. It's a reflection of human behavior, and our behavior is controlled by our genes. And I've looked back at charts for over 100 years, and the charts are the same. The price action
I
on the
think
charts are the same
this
as
one,
they were
this one will
long
help.
ago. And since I believe price action is a manifestation of human behavior and our chromosomes, it will continue to remain valid until we become a new species. On the right, here's a chart from the Great Depression, and if I didn't have the time on the bottom, you would assume it's a chart from today. On the left, there's a chart of World War II, again, the patterns look the same as they do today. Crashes are common. 1987, most of us were around in 1987, and this is a daily bar chart of General Electric during the crash of 1987. Big bear spike and then a triangle. It looks pretty much the same as this 5-minute chart of Costco. A big bear spike and then some kind of a pullback. And the same as a 1-minute chart of the E-mini. And you see this every day. The E-mini crashes every day on small enough time frames. So there's nothing special about a crash. In terms of price action, it's the same on all time frames. When you start out as a trader, you look for information and you look at the internet, you'll find websites, you find videos, you buy books, you read books. And I think it's easy to be struck by just how much information there is out there about candlestick patterns. And I think the message is clear to somebody starting out that candlestick patterns can make you rich and that they're the key to success. However, you correctly believe that Goldman Sachs, high-frequency trading firms, and hedge funds make a fortune, and that they're not using candlestick patterns to do so. High-frequency trading firms, for the most part, are using tick charts, so they don't see candles at all. And most of the hedge funds are using a combination of technical and fundamental.
So I'll just
And talk about their trades. And they constantly talk about the trend. And they'll talk about channels. Oh, it's near the bottom of the channel. Good place to buy. Prior highs and lows. Oh, it's pulling back. This bull trend is pulling back to that old high. This is support. I'm going to buy there. Do you ever hear them say that they sold the bull trend because there was a dark cloud cover or shooting star or Harami pattern? No, you don't hear it because that's not what they're doing. Let me give you an example of a candlestick top in a bull trend. Can you make money from it? Absolutely. How do you make money on a candlestick top in a bull trend? Well, first of all, you don't sell it. You wait a few bars, figure out where the bears will exit with their losses, and you place a buy stop to get long just where they're getting stopped out. And that's how you make money using a candlestick top. You bet that it's going to fail. Because most tops fail, and you should get long where the trapped bears are taking their losses. Here's an example of Apple daily chart. There is a bearish engulfing pattern, very strong bear bar, a standard candlestick topping pattern. So, should you sell the close of the bar? Should you sell below the low of the bar? Well, on fast money on that day, what I heard were traders saying, Apple sold off $20, and the last few times that it sold off $20, it rallied. I'm going to buy. And they were correct. Okay, so those traders on fast money were buying down here at the close of this bar around the moving average. They don't use the 20-bar exponential moving average like I do, but to me that's a buy. The market has not touched the moving average in 20 or 30 bars, and it's a strong bull trend, possibly forming a trading range, but in any case, if it is, it's near the bottom. So instead of looking at this wonderful reversal pattern and saying, wow, I better sell this candlestick pattern, because I saw it on the internet that it's a great top. Well, in fact, most experienced traders would see just the opposite of what you're saying, and they would say that it's a bull trend. Most reversal patterns will fail, and they'll become bull flags, and it's far better to look to buy the pattern than it is to sell. And this is what followed. A pretty strong rally, and the traders who bought the pullback did quite well. The market tends to have inertia. It tends to continue what it's been doing. If you want to see what the bars to the right look like, just look to the left. Right, the market tends to continue what it's been doing. And if you're in a bull trend, 80% of tops will fail and become bull flags. If you're in a bear trend, 80% of bottoms will fail and become bear flags. If you're in a trading range, 80% of breakout attempts up and down will fail, and the market will reverse and go to the opposite end of the trading range. So there's much more to a top or to a bottom than a candlestick pattern. And in fact, candlestick patterns are not necessary at all to make money. And my guess is most of the very best traders on Wall Street don't pay any attention to the candlestick patterns. Trading is very difficult, and every trader learns quickly that it's easy to lose money, and they do lose money, no matter how hard they try. They read, they study, they watch television shows, they take online courses, they hire tutors, they go to conferences. They try really, really hard to do this, yet no matter how hard they try, they lose, and they lose for a long time. And it does not matter how much they know about candlestick patterns. And so candlestick patterns are not all that helpful. In a way, they're like a false guard. After losing enough money, people tend to get desperate, and they're desperate to believe in anything. Will you please help me? This person says he's an expert. I'm going to go follow what he's preaching. And many of these people are well-intentioned, right? And they preach that candlestick patterns are the road to financial heaven. And they're trying to be helpful, and they really believe it. But there's really much, much more to trading than candlestick patterns. And candlestick patterns are not even necessary to the success of a technical trader. They're one of the least important aspects of trading. Just listen to what the traders on CNBC tell you, and they tell you this every day. They talk about why they're taking trades, and you never hear them talk about candlestick patterns. What you hear them talk about is, the market's near the bottom of a channel, I'm going to buy. It broke out, now it's pulling back to that prior high is now support, I'm going to buy. It broke to the downside, and now it's coming back to the bottom of the upper trading range, therefore it's approaching resistance, I'm going to sell. They also talk about whether the trend is strong. Is the market continuing to make higher highs and lows in a bull, or is it making lower highs and lower lows in a bear? This is the stuff that they're talking about. They're not talking about Harami patterns, dark cloud covers, hanging man patterns. And why is that? Because those things don't help them make money, or at least they don't help nearly as much as these things. These are the keys to making money, not candlestick patterns. You also hear them assess buying and selling pressure. They may not use the term buying and selling pressure, but they'll talk about, the trend looks really strong. The bull trend looks strong, or the bear trend looks strong. And they'll also talk about risk and reward and probability. Every now and then they'll specifically mention the three together in the same sentence. That, the risk is small and the probability is small, but the reward is so huge that the trade makes mathematical sense. You'll especially hear option traders talk about that, where they'll take a trade that has very little chance of success, but they feel the reward is so much greater than the risk that the trade is worthwhile. And another very important thing is trade management. What do you do once you're in a trade? Do you trail your stops? How do you trail your stops? Do you scale into a trade going against you? Every now and then you'll hear them on television say, I bought and it's falling, I'm going to buy more. And they're not saying, oh, I bought a bottom of a candlestick pattern, and now it fell, and there's another candlestick pattern, I'll buy more. What they're saying is, no, I think the trend is up, and that this is just a pullback, and we're in a support area, and therefore I think the trend should resume because 80% of the time, that's what trends do. You need all of that and more to be a successful trader. And candlestick patterns are totally unnecessary. They can be useful, but they're a small piece of the big picture. When you hear people talk about setups, I'm looking for a buy signal. All you get from the internet is they're looking for a candlestick pattern. The candlestick pattern is the signal. The setup is made of two things. It's made up of the signal, the candlestick pattern, for example, and the context, all of the bars to the left, all of the things that I just mentioned, all that support and resistance. And you cannot be successful as a trader without all of that stuff to the left, all the support and resistance. You can be successful as a trader without candlestick patterns and without the signal. So the context is far more important than the signal. Both go into making a setup, and the best setups have a strong context, like buying your support, selling your resistance, and a good signal bar to help trigger the trade. But the signal bar is just it's just helpful. It's not necessary. And you can buy a strong bear bar, the close of a strong bear bar in a bull trend, even though there's no candlestick buy signal. You can sell the close of a strong bull bar in a strong bear trend, even though there's no candlestick sell signal. The context, what took place to the left, is far more important than what took place over the past bar or two or three with the candles. Okay, trading can make you rich, right? However, this is not the way to do it. When I first started trading 25 years ago, this is pretty much what I did. I put many indicators on my charts and hoped that they would make me rich, and I lost money. And one day I decided to get rid of all the indicators and just look at the charts. And this is that same chart that I just showed a minute ago, but without all the indicators on the chart. And when you look at it this way, it becomes
So
pretty clear.
once we are
We're
done
looking
with the
a decent looking wedge over
listening,
here,
then we'll
and then a bull
start
spike, and then a pullback from the breakout of the wedge, and
analyzing the
double bottom bull spike,
stream and
another breakout,
everything.
and another pullback. So if you get rid of all the indicators and just look at the chart, just look at the price action itself, a lot of times you'll see things that you cannot see when you have the indicators present. And you don't have to look at the 5-minute chart. You can look at any kind of a chart. For example, here's the same chart where there's 1,000 ticks per bar, and the overall shape is still the same. So the price action is still the same. Okay, here's another version of the chart where there are 300,000 shares per bar, and again the price action is the same. Here's a range chart. This is a range chart of the same 5-minute chart of Petrobras PBR, and again the same basic structure is present on this chart as was present on the other charts. It does not matter what type of chart you use. All they are is representing human behavior. Monthly chart Petrobras. Okay, again basic price action is the same. Parabolic buy climax, the final flag, strong bear spike, pullback, test of the low, and there are tradable patterns all the way through the chart. This is the end of the module entitled "What is Price Action?"
So basically, what we learned from this video is that uh, basically the candlestick patterns that are going through in the internet, on the YouTube, on Instagram, and any other social media platform. The main thing they talk about is basically if you have an engulfing pattern, if you have a some three green pattern, some red pattern, the shooting star, the what I'll say, doji, then hammer, everything. These are not like the institutions that are using, because the institutions will not look into the chart whether it is forming that or not, because the institutions are the one who is forming the, what we'll say is like the chart basically. So what we can understand is that, I'll just give me a second, I'll just open paint and we can understand a little bit clearly. So what's going on? Let me make it into the full screen and got it. Oh, whatever this. Yeah. Let me take an eraser. Oh man. Let me fastly remove this one. Okay. So now we basically entered here again. Okay, brushes. Okay. We'll use a base brush, which looks good and everything. Okay. So basically first what we can do price action on any chart from starting from any chart. If you take forex, uh, I think I need to start uh, explaining you guys from a different one which seems good than this. Either forex. Okay. Oh fuck. Oh, man. I'm so naive in all this. Okay. Let's learn here in this itself instead of worrying in their understanding and oh man. Okay. So basically, what I would like to tell is, uh, in the forex market, or if you take futures, if you take options, if you take anything that has a chart that can be plotted, can be uh, used as a price. We can use price action for trading that, or for using that for what I'll say is like for and getting it to know more better. So the first thing we would like to do is like go to the higher time frames, know what is happening there, then come back to the smaller time frames and take a trade which can give us from 5 trades to 10 trades or to 100 trades or one trade, even if there is no setup, if there is a setup and everything. So the thing that we are looking at now is how can we trade. Basically, if you look at into the when you start trading like me as a beginner, we'll go to the YouTube and then watch some videos where they'll have three, they will just replay, like what we'll say is like replay the same thing. They know what is the outcome, then they go back into the time using the like trading view or a ninja trader or anything, then they will start trading from there. Then they will just play the trade according to what they want to say by giving voiceovers and what. And also, this is not what we are going to do. This is where we are learning and applying those same skills instantly on the market by using the Ninja Trader. I have two Bullnox accounts, Evolve and two Phidias accounts and one my funded future. So we'll like to trade on everything by learning, and this we will use it as a example for the future trades and analysis. And I'm thinking to take we'll keep the risk management also in the play in the next videos where we learn them. Before that, we'll just do what normally, and we'll take $100 or $75 trading loss and limit. Yeah. The next thing what I'm going to do is like stream mm, uh, the next video of price action trading, and let's get out. Give me a second, guys. Let me download the video.
This is Al. This is Al Brooks, and this is my price action trading course. This module is about the market cycle. The market's in a never-ending cycle, alternating between being in a trend and a trading range, and then a trend again. When it's in a trading range, it can break out in either direction. The trend can be up or down. It does not matter what the direction of the trend was before entering.
So basically, the market will have trend, trending range, and again the trend. In trend, there will be breakout, then there will be some channel. What does the channel means? Like there will be an line we draw on the bottom or top, or on both bottom and top, and the price moves on the same direction for a longer period of time. Then that is called channel. Once it breaks the channel, it becomes a breakout. When it becomes a breakout, it becomes a trend again. So the market is a never ending cycle which will stay in market breakout, then trading range, and then trend. Okay, so let's continue the video, and while we go through it, we'll have some understanding of the video, and we'll keep it in 2x so that we can understand better and faster. And as you know, the
The
psychology.
trading range. Every trend is composed of a breakout phase, which is an initial big trend bar or series of trend bars, and then a channel phase when the market starts to have pullbacks, but still contained between a couple of lines. Channels eventually get flatter and broader and become trading ranges. Trading ranges eventually break out. And if you look at any trading range, you can usually see the beginnings of both a bull trend and a bear trend. The market may have a lower high and it may have a higher low. The lower high may be the start of a bear trend. The higher low may be the start of a bull trend. And at some point, the market breaks out and one side wins. Usually, you look for signs of buying or selling pressure within the trading range to get an idea of which side is more likely to win. You can view a trading range as a transition between trends. So you have a trend, the market pauses, hesitates, and then decides what to do, and then it becomes a trend. So the trading range is a transition between trends, but a trend is a transition between trading range. Trading ranges. There's a trading range, and then the market decides the price is wrong. It has to quickly move to a new price level, a new value level. It might be up, and then a new trading range. It might be down, and then a new trading range. The trend can be strong, like a breakout, a series of very large bull trend bars, for example, in a bull trend, or it can be weak and contained within a channel, overlapping bars and pullbacks. Trading range can be as small as a single bar pullback, or it can be as large as the entire screen. When a trading range is small and it forms within a trend, it's called a pullback. And when it's a pullback, it's part of the trend. It's a pause in the trend, and you believe that the trend will resume, that the breakout will be in the direction of the trend. When a trading range lasts a long time, 20 bars, 30 bars, 40 bars, it loses its direction. The trend is too far in the past, and the effect that the trend has on the market is too remote. And at that point, the breakout can be in either direction. The trading range means that the trend has lost its influence over the market. The trading range can end up being a continuation pattern leading to a resumption of the trend, or a reversal pattern. In fact, all reversal patterns are related to trading ranges. Head and shoulders tops, for example, are trading ranges. A pullback is simply a small trading range that is a pause in a trend, and you're assuming that the trend will resume, usually within a bar or two, sometimes 20 or more bars. And on a smaller time frame chart, a 1 bar trading range, for example, on a 60-minute chart, could be a 12 bar trading range on a 5-minute chart. Again, if the pullback grows so long that it loses its direction, you look at it and say, well, I don't know if it's going to break to the upside or the downside. At that point, instead of calling it a pullback, you call it a trading range. And all pullbacks are trading ranges on smaller time frame charts. All trading ranges are pullbacks on higher time frame charts. If you have a trading range that is 36 bars long on a 5-minute chart, it could simply be a 3-bar pullback on a 60-minute chart. This is an example of what I'm talking about. This is the weekly S&P chart. This is the spider, and the green boxes are trading ranges. And I'll look at the first one here. So we have a trading range. We have a bull trend leading up to it, and then a trading range, and the market broke out in the direction of the trend, bull trend, right? So we had a bull breakout. And then within that bull trend, we have another trading range. However, this one broke out in the opposite direction. So sometimes the trading range will break out in the direction of the trend, other times it'll break out in the opposite direction. Here, on the left, we had a strong bear trend, and then a trading range, and then a breakout. However, within 3 bars, the market reversed. The breakout failed. So the trading range can break out in the direction of the trend, it can break out in the opposite direction, it can break out in one direction and then reverse and go in the other direction. All trends begin with a spike. You can call this single bull trend bar the spike, or you can call this series of bull trend bars a spike. As soon as it begins to have a pullback, it's entering a channel phase, a more two-sided phase. So we have a spike and then a channel, and usually the channel begins with some kind of a pullback. Again, you can view trends as just transitions between trading ranges. Here's a trading range, then a trend, and then another trading range. And you can view trading ranges as transitions between trends. We have a trend, a pause, and then another trend. Channels usually become broader and flatter, and at some point they lose. The pullbacks become so long that they lose their directional predictive ability, and then you look at it and say, well, I don't know, maybe we're forming a double top bear flag and we're going to break to the downside. We have a low and we have a lower low, we have a lower high, maybe this is the start of a bear trend. If the market did end up down here, you would look back and say the bear trend began here. So in fact, this is part of a bear trend. Here we have a higher low. If the market goes up, you'll look back and say the bull trend began over here. So within this trading range, the market is in a trading range. It's also in a bear trend, beginning of a bear trend, and it's also in the beginning of a bull trend, and that's very common. Trading ranges usually have trends within them, and if you have both a bull and a bear trend, one will end and the other will succeed. Here's another trend. We have a higher low, right? So we have a trend and then a trading range, and we have a higher low and a bull spike. If the market ended up here, you'd say the leg began over here. So this is actually the first leg of a new bull trend. A spike, maybe we have a pullback, maybe we'll get a channel up, right? But spikes don't always succeed. In fact, most breakout attempts fail. Here we have a bull channel, and we tried to break to the downside, and it failed. Here we have a trading range, and we broke to the upside, and it failed.
Sorry for the moment.
Here's the same chart showing that within every thing that you saw in the prior chart, there are nested patterns. There are smaller versions. So within this channel, there's actually a spike and a smaller channel. Here's a spike. This trading range is also in a channel. On every time frame, the market is both in a trend and in a channel. You can look at any segment of the chart, and if you go to a higher time frame chart, it's something else. So here we have a bull trend, but for a while we had the start of a bear trend. In fact, you could call this a small bear trend. And it's also a trading range. And within every trading range, there will be trends. Here's a small spike and channel. Every part of the chart is always either a trend or a trading range. Every bar is either a trend or a trading range. Here's a 1 bar trend. A doji bar, it's a small body, it's a 1 bar trading range. So everything is either a trend or a trading range on every.
In the meantime, let's so guys, uh, let's have a look at uh, the MNQ, and let me turn on the what will say chart trader. Okay, let's change it to account. Yes, and let's off the chart trader. Okay, Uh, so what he is going to say, like, yes, we can see it almost appears in every day. So, like, let me draw in 1 second. Mm, okay, let's draw a rectangle. Okay, yes, you guys can see this is a continuous bars, a series of bars without any downward momentum majorly, and it continued till here. Then the market went into the range. Okay, yeah, this will be good. Yes. Okay, let me delete this one. Sorry. Uh, let let us draw this one. Okay, the market has a spike. Okay, this we can call spike, or this can be called a reversal from here. If we don't have the previous one, then we can call this as then the market went into trading range. You can see here till here. Oh fuck, man. Okay, I'll just the market moved almost an hour from, I'll just change it color to red. Till this time, the market tried to move in the trading range. Then it had a breakout. What we can say is like a breakout. Uh, from here, it had a spike till here, and then a small pullback. Then it continued moving. Then it went into a trading range and micro channels. That and all. This I am telling why, because I just uh, about to learn this one, and I understood little bit that part of it. Now I'm continuing it again. Okay, so let's go in depth what he's telling and understand anything. Yeah, let me continue to play the video. So this is what market will do continuously day by day, every day, any chart. I have shown you the example of MNQ, how it will works. So let's go into
Time frame every
depth
type of
and
chart, and it doesn't
understand
matter.
what is
You have to
going on.
understand that this is what the market does, and if you know where you are in the market cycle, you can use trading techniques that are appropriate and give you a better chance of making a profit. So if you're in the spike phase of a trend, once you decide, yeah, this is going up, you have to get long, right? You cannot say, well, maybe I'll wait for a pullback, because sometimes the pullback does not come for a long time. Here's another example. Yes, it's in a trading range, but we're trying to get a series of bull bars, and we broke out of this bear channel. Once you decide that, yeah, I think the market's always in long, you have to get long, because sometimes the pullback does not come for a long time. Once you decide that it's in a trading range, you have to decide, well, it's probably going to go up and down for a long time. I better buy low and sell high, and I better not hold my position for long, because it'll come back to my entry price. So if I buy here and hold, it comes back here. So once you decide it's in a trading range, you got to buy low and sell high. You can sell high to take profits on your longs. You can also sell high to go short. And when it comes down again, buy low, sell high. You buy back your shorts to take a profit, and you also might buy to go long. But if you hold, invariably, the market will come back to your entry price. So if you bought here and held, it would come back to your entry price, and your profit would disappear. If you sold here and held, it would come back to your entry price, and your profit would disappear. So the best way to trade in a trading range is to scalp. Buy low and sell high. Here's a 60-minute chart showing a spike phase, a strong bull trend, followed by a channel phase, a weak bull trend. And channels are usually followed by trading ranges. The channel evolves into a trading range. So we have a bull channel, and then more sideways, and the entire screen becomes a trading range. Within the trading range, there's a bear spike, a gap, and a series of bear bars, followed by a channel down. And then there was a bull spike, a series of very strong bull trend bars, and then a broad bull channel. And within each part of the trend, there are smaller elements. There are nested patterns. So within the channel, there's a bear spike going down, here's a bull spike going up, and a channel. A bull spike and a channel. Here's a bear spike, and within the channel, there's another bear spike, and then a smaller channel. Why is it important to know about the market cycle and where we are in the market cycle? Because each part of the cycle has different trading opportunities. And if you know where you are in the market cycle, a breakout phase, a channel phase of a bull trend, the approaches that you use to trading are different from those that you would use in a trading range. In general, I try to turn everything into binary decisions. I try to give myself just two choices. When you're trading, you want to think about as few things as possible, and one way to do that is to try to structure your analysis in a way so that every decision only has two possibilities. An example of a binary decision in a bull market is whether the bull trend is a trend within a actual bull trend, or is the rally simply a leg within a trading range. And that's important to distinguish because you trade those two rallies differently.
Hmm.
In a bull trend, you're only looking to buy, and you should be swinging at least part of your trade. If it's a bull leg within a trading range, it's good to take the buy signals. However, if there are strong sell signals, especially if there are second entry shorts, you can take those as well. And within a trading range, in general, the focus should be on scalping instead of swinging. In a strong bull trend, that's the breakout phase. I also call it a spike. You need to get long immediately. You should, in general, if it's a bull trend, you should buy at least a small position at the market. A lot of times you look at it and you say, wait a minute, the spike is so big, my stop has to be far, far away. That's right, that's where your stop has to be. But the reward is so large that it's worth it to take at least a small position and use the wide stop. When the trend weakens and it enters a channel phase, if it's a very tight channel, it's essentially it is a breakout on a higher time frame chart. It's a spike on a higher time frame chart, and you should trade it exactly like a breakout. So when a channel is very, very tight and very vertical, very small pullbacks, trade it just like a breakout, a strong bull trend, and only look to buy. If the channel starts to get broader and flatter, less vertical with bigger swings up and down, you should always make sure to take the buy signals if it's a bull channel. But if the swings are very big and it's basically a trading range that slopes only slightly up, you can trade in both directions. And in that case, the more it resembles a trading range, the more you should trade it like a trading range. BLSHS, buy low, sell high, and scalp. If the market's going down, also binary decision. It's a bear trend or it's a bear leg within a trading range. And again, you trade them differently. If it's a bear trend, only look to sell and try to swing at least part of the position. On the other hand, if it's a bear leg within a trading range, you definitely should take the sell signals. But if the buy signals are strong enough, especially if there are second entry buys, you can take them as well. And again, if it's a trading range, it's better to be scalping. If the market's in a very strong bear trend, the breakout phase, the spike phase, you need to get short immediately. If you can't figure out how to get short within the next minute or two, sell at least a small position at the market and put your stop at the top of the bear spike. It's a very wide stop most of the time. When that's the case, just trade small and then look to enter more as the trend progresses. If the trend is a weak bear, in other words, if it's in a channel, it depends if the channel is tight or broad. If it's very tight with very small pullback,
Okay.
and it's very
Let's
vertical,
watch
then
till
trade it
the
exactly
end.
like the breakout phase, the strong bear trend, and only look to sell and try to swing. If it's a broad channel, you make sure to take the sell signals because it's still a bear trend. But if the swings are big, trade it like a trading range. Buy low, sell high, scalp, and take trades in both directions. That's the end of this module on the market cycle. Thank you.
So basically, let me get my chart up. Okay, so we have a chart here. Okay, in this chart, we are gonna mark the where is channel, where is trading range, where is spike, what is happening, and where is everything. Okay, first let's go through in-depth understanding of what we learned today till this video. Okay, first basically the market has a trend channel till here. Okay, the market has not made major moves. Okay, it's not proper. Let's make, okay, if you can look at the market, it always touched and bounced back. Okay, yeah, it's better if you draw using two horizontal not non-extended lines. Okay, let me show you. Okay, the market had a channel formed in the top and even the bottom. Okay, you can see that. Let me show. Okay, the channel can be formed in two lines. It doesn't matter. Okay, basically, if you delete these two lines, what we had is like a spike from here to there, then it had a small pullback, then it went into the trading, like a small channel where the price moved very strictly, a micro channel, we can call it tight channel, then it went into a trading range, and after some time it has a breakout phase. And if we are looking at 1 minute chart, so it is looking a little bit different. If we go to the higher time frames, we always know it will be different. Then it went to the breakout phase, then it had a small pullback, then it continued to go up, then it went into the small pullback, then it has a micro channel, then it has a breakout, like trading range, then it has a breakout. Like the breakout can be in any other direction. So this is what I'm telling. So this can be seen in every market every day, like in anything. So when you're like this, when you're having this kind of a bull run, you would like to enter at any price, and you can exit at when there is a pullback, or when you think that it has reached the potential of the trend, by watching the volumes and everything. So we'll go through the volume section a little bit differently and a little bit later. And this is what the plan is, that understand the market, what is going to do, and then enter the market, have some good trades and exit the market. We can trade now and we can see how it is going on. So let's go what is happening in the current time period. So the market is currently moving in a trading range. Okay. Uh, Let me extend this so that we can see clearly. So this is a downtrend, and it has a small pullback. Then it continued to go in the trading range, and then it broke out and had some couple of bottom where, and then it goes on to do this one, what the market want to do. So if we are looking at the things that we have learned, we can analyze them and we can add this to this a real life pattern. Next, we are going to learn about. I think that's enough for today. Tomorrow, we'll start continuing understanding the next things. Thank you, guys. Have a good day. I'm ending the stream.